Hello everyone and welcome to your Glassnode video report for week 37. I'm your host Checkmate and we're recording this on the 14th of September 2021. So this week we opened with a push up to a high of about 52,800, which is a multi-month high. However, what we then saw is a long squeeze, which actually drove us down to about 44,000. So we saw a bit of upside and downside volatility to really open the week, and the market consolidated from that point onwards. Now, the main driver of this volatility was actually largely derivatives markets. So we saw futures open interest climbing. We talked about this last week, and what we actually saw is the unwind of that. So essentially the risk that we were covering essentially did eventuate a couple of days later, and we saw that flush out of excess leverage and derivatives to the downside. So what we're going to look at is really unpicking that derivatives unwind, but we're also going to look into the HODLer behavior. What did the overall market actually, how do they react to it? What did the spending behavior on chain look like? And we're going to zoom in on the HODLers of last resort, the buyers of last resort in this market, who essentially are there, rain, hail, or shine. And we're looking, are they selling their coins? Are they spending? What's the overall dormancy of the coin supply at the moment? What's their spending behavior? And really zoom out into a very big picture macro view on the supply dynamics and the accumulation trends. So we're going to focus on that long-term holder basis and really how they've reacted to essentially the volatility we've seen since May right through to the recent sell-off. So let's jump into Glassnode Studio and we'll get started with our analysis. So here we are in Glassnode Studio. We're looking at our week 37 on-chain dashboard. As I mentioned in the intro, we saw this push up to a local high of about 52,800 for Bitcoin, a similar rally to a higher level for Ethereum, and then we saw a fairly dramatic sell-off. So within an hour, it was about a $10,000 drawdown for Bitcoin. We saw a similar pullback, essentially back down to the previous consolidation range for Ethereum. So really the market reacted. It sold off very, very quickly. And the largest driver of this was actually the risk that we talked about at the end of last week's video. So we looked at this open interest, this growth in leverage that was coming into the system. We noted that we had this acceleration. You can note that it's almost a miniature parabola in terms of open futures contracts on both Bitcoin and Ethereum actually pushed up to an all-time high when we recorded last week's video. So there was a very, very large amount of open interest in the system. We can see that we had a positive funding rate, which is showing that the traders who are trading these perpetual markets are willing to pay an interest rate. So long traders are willing to pay an interest rate to the short side to essentially take on that leverage. It's almost like paying a cost for the privilege of taking on the leverage. So the market was leaning to the positive side. It was leaning long. We saw this growth in open interest, and then we saw for Bitcoin a flush out of about $4 billion worth of open interest. So all of these contracts were closed. Some of them would have been stop losses. Some of them would have been liquidations. Similar for Ethereum. And note that the open interest has essentially traded sideways since that point, alongside price. It's really found a new footing. We've flushed out a lot of excess leverage. It hasn't been growing from that point on. It's showing that people are now employing more and more risk management and really closing out and reassessing their positions. We can see that funding rates has closed back to very, very low values, so it was slightly positive, but nowhere near where it was previously. So we really have seen this clearing out of the excess leverage. It's closed back down to a fairly neutral level, and it's really showing that at the moment we don't have that massive long bias that we had previous to the sell-off. But it also goes to show that even though our positive funding rate was lower than what we saw back here in Q1, Q2, it really does demonstrate that there's not necessarily an absolute value of funding rate that says it's too high or too low. What we're looking at here is the combination of a rising price, an accelerating open interest, and positive funding rate. So it's kind of the combination of things that really led into this event. Now there's two other metrics here. We've got our long liquidation dominance. So in other words, when this is trading at 50%, it's saying that whatever particular move is going on at that time is roughly equal long versus shorts liquidation. There's kind of an equal balance of longs and shorts being liquidated at any particular time. When it trades in a positive sense, it's actually showing that more long positions are being liquidated. And we can see these long positions getting liquidated, particularly during drawdown. So we get these rallies higher, we get a drawdown, and that rises up the longs that are being liquidated. So more longs get liquidated because they're caught on the wrong side of the trade. They open up positions near a local high, and price pulls back and liquidates them. Now, what's quite interesting about the market dynamic this week, let's actually zoom in on a 1 monthly basis so we can really see this up close. So as we pushed up to the all-time, sorry, not the all-time high, the local high for Ethereum, maybe 1 month is a little bit too close. Let's zoom out a bit more. That's a bit better. So as we pulled up to this high at 52,800, we actually had a whole bunch of shorts get squeezed. So shorts were liquidated, and then we had the sell-off, which actually liquidated to the long side. Likewise for Ethereum, we had shorts being liquidated that pushed us up to this local high, and then we had longs being liquidated as price pulled back. So it actually showed we almost had a whipsaw motion where a bunch of shorts were squeezed to the upside, a whole bunch of people stepped in, and this actually correlates with a rising open interest. So as those shorts were liquidated, more and more people stepped in and took on long positions, and then those long positions were actually squeezed back in the opposite direction. So very much a volatile whipsaw type motion. We saw an expansion in our options volume. So these are people who are stepping in and actually either buying options to hedge their risk and take some of that risk out of the market. And then you've also got sellers of options who are capturing that volatility premium. And we see this typically around either large volatility to the upside or during significant sell-offs. We see this rising options volume as we get these major moves, whether to the upside or the downside, showing that more people are stepping in and actually hedging their positions, and others are selling those options to capture the volatility. So we're starting to see this fairly intricate dynamic between leverage, derivatives, futures, options, and spot markets. At the moment, the options markets are relatively small compared to the futures markets, but over time, we're likely to see that start to build up. So this interplay between these different market structures shows that you can't just look at on-chain data, and you also can't just look at market structure data. Using all of these in combination actually provides a very powerful tool set to assess the overall state of the market. So that's really looking at what drove this sell-off. We essentially had some volatility to the upside, volatility to the downside, and it was driven by a squeezing out of leverage, a flushing out of too many people betting on margin to the wrong side. Now, the response to that, when we look at, we've got our derivatives markets, which is kind of one sector of the crypto space. We then also have our spot and our on-chain markets, which tells us information about the buyers of last resort, the hodlers, people who are in the system for the long term. We can generally use on-chain analytics to track these folks because they're the ones who will actually withdraw coins out to cold storage, hang on to them for months to years, and perhaps only sell some portion of them as we get closer towards the end of a particular cycle, and they believe that coins are getting expensive. So it's quite powerful to track what's going on with these buyers of last resort, these hodlers. And one of the key inputs that we use in on-chain analytics is coin lifespan. So how long it's been since a coin was last moved. And as you can imagine, the longer that somebody holds onto those coins, the higher probability that they've weathered some volatility, they've seen, market dynamics and regulations, and the way that this space is just volatile in its very nature. They've weathered a lot of that storm. So once you've weathered that storm, you generally understand the market dynamics a bit better, you're more experienced, and these hodlers typically understand the general trends better than people who are entering for the first time. So that's why it's quite powerful to track the on-chain, the hodlers, and understand what's going on here. Now, the first metric we're going to look at is average coin dormancy. We have our standard version and our entity adjusted version. Now, what dormancy looks at is for every coin that's spent, it destroys the accumulated lifespan, or it destroys the coin days. We consider it reset back to a value of 0, and it starts to age and reaccumulate lifespan again. So we look at and we sum up all of the coin days that were destroyed, how old was the overall coinage that was spent, and then we divide it by how many BTC were moved. So what dormancy provides us is a view of how much lifespan was spent or destroyed per unit BTC on a per unit basis. So what we can see on the left-hand axis is essentially, when we're looking at a value of 20 for dormancy, it's saying that on average of the coins that were spent that day, it was 20 coin days per BTC that was spent. So it tells us a bit of an average age across the whole spent coin supply. Now, what we saw in October through January during the bull market, the first phase of the bull, was more of those older coins. This uptrend in dormancy means old coins being spent. The average age lifts, so that means that older coins are coming back into circulation. We can see this in our revived supply. So this is the coin volume coming back to life that was older than 1 year. We saw this uptrend in revived supply, uptrend in coin dormancy, or the average age, and this is equivalent across our standard and our entity adjusted metrics. So what we're really seeing is that during that first bull phase, more of those old coins came back to life, sold into strength, took profits. Now, on the reverse side of that peak in January, we actually saw a continued downtrend in dormancy, likewise in revived supply greater than 1 year, and likewise in revived supply greater than 2 years. So what we're actually seeing here is that the overall supply of the older coins actually stayed fairly dormant, increasingly so. So as price topped and eventually sold off in May, and then finally reached the capitulation point down here at 29,000, we actually saw a continuing reduction in the amount of revived coins. The amount of revived coins greater than 1 year and coin dormancy has continued to trend down. Now, we see that we've got these two spikes in standard dormancy. Only one of those is present when it comes to entity adjusted. So that tells us that one of these, the second one, was actually more likely to be an internal transfer, one of these older wallets that an exchange was managing. But the important thing to take away from this is that during the 2020 phase, here it was very, very sideways. We kind of have this regular stable baseline of average coin dormancy, likewise for entity adjusted dormancy, revived supply. This is our accumulation, our pre-bull accumulation phase. This is what hodlers look like. These are people who have weathered the 2018 bear market. They've stuck through the volatility of 2019. They've looked at what happened on March 2020, and they've been stacking sats the entire time. So this is how we can characterize these buyers of last resort. This is them spending. This is them slowing down their behavior. And note that we've actually returned not only to, but actually lower than in terms of dormancy, breaking down on all of these metrics, we've actually returned to this stable baseline. So in other words, that's telling us that hodlers are hanging onto their coins. They're preferring not to spend their older coin supply more and more and more. We see this play out in our hodl waves. We're seeing these warmer colors continue to decline. So we're seeing fewer and fewer young coins. And we actually hit an all-time low this week of young coins. So coins younger than 1 month represent the smallest portion of supply that they ever have. Now, what that otherwise means is that coins older than 1 month are now at an all-time high. There's the maximum number of older coins in the system. So there's this inverse relationship between young coins and old coins, because if they're not young, then they have to be older. So we're seeing all of this behavior actually playing out in our hodl waves, this downtrend in these young coin bands and this progressive swelling of these older coin bands, which we've covered a number of times in previous videos. So I do implore you to go back and check those out as we go through. But what we're seeing here is this progressive aging of coins. We're seeing coins transitioning from younger to older bands. We're also seeing this play out in our supply dynamics. So this is our long-term holder supply on the right-hand side here. You can see the magnitude of coins. This is actually an all-time high up here at about 12.96 million coins. We're closing in on 13 million coins, which is a substantial volume of the total coin supply. We're seeing more and more of these coins transitioning across that 5-month, 155-day boundary, which is really where, statistically speaking, they become increasingly less likely to be spent. So normally when a coin has been dormant for around 5 months, the next candle is probably not going to scare that particular holder. They generally spend those coins. They're people who've, again, they've weathered that volatility. They've seen this market. They're more experienced. Generally, they're spending their coins when they believe that they're overvalued, not necessarily in a panic. So we typically see that as this coin supply rises, it's showing us that those hodlers are continuing to hang on to their coins. Now we've got here our long and short-term holder supply, profit and loss. So let's break down that metric. In the blue, we have our long-term holders. These are coins older than 5 months, 155 days, which from to the day of recording, that puts us somewhere up here towards the all-time high, somewhere in mid-April. So all of the coins that were accumulated prior to the all-time high, which was on the Coinbase direct listing, all of those coins are classified as long-term holders. So everybody who bought on the way up is essentially a long-term holder, and everybody who bought on the way down to where we currently are is a short-term holder, shown in red. Now the dark blue and the dark red are long-term and short-term holders that are currently in profit. The price is currently above the price when their coin last moved. And in lighter colors are showing those the opposite, which are currently underwater, those that bought up the top here or those that bought up the top here. Now what I really want to highlight to you, so we've already said that from the all-time high down onwards is short-term, so that's in the red. Now note that the dark red, these are coins that are in profit. The only coins that could possibly be in profit at the $52,000 high are those bought at the very, very tippity bottoms of these dips or in the previous consolidation range in this rally. So essentially what we're looking at are the coins that were purchased more or less since we had the sell-off in May. That's the dominant majority of short-term holder coins that are in profit. They're going to be all of these coins that are currently in this consolidation range. Note how large this is. This is actually 16.8% of the total coin supply. So in other words, 16.8% of all BTC were accumulated during this particular range and on the rally higher, below where we currently are at 44,000. Or sorry, 52,000, I should correct. That's a fairly substantial volume of coins. And this is what I'm saying when I'm talking about these hodlers of last resort, these people who are stepping in and buying when the chart is probably looking the worst. I mean, from a technical analysis standpoint, the chart looked very grim down here at the $30,000 to $29,000 range. There's a number of times when it started to capitulate. We saw lots of capitulation on chain. People who bought their coins at the top here, exiting at a loss and selling their coins. Those hodlers were actually stepping in and buying those. So even though the chart looked pretty grim, they were accumulating 16.8% of the coin supply. So it shows the magnitude of that buy side down here, and we can then extrapolate that forward and say, well, it's pretty likely there's a strong on-chain support. There is demand down in that zone. So that's a key takeaway. And note that these coins that were purchased down here, they won't transition, they won't enter this long-term holder supply for 155 days from the event, which is going to put us somewhere over towards December. So in December, what we're going to start seeing is how this market reacts, how many of those coins continue to be held, how many of them were just sold for a quick profit. We will start to see that behavior. Now we can see this in our long-term holder net position change, not from that zone, but certainly what occurred during the actual rally north. So this is what we're seeing here. These are coins that were purchased during the first leg up of the bull market from October all the way through to April. These are these coins. We're seeing this very, very significant volume. This is about 420,000 BTC per month, crossing that short into long-term holder territory. So it's showing that a very, very large proportion of those coins that were purchased during the rally higher actually still have been unspent, which is quite remarkable, to be honest. We're showing that even though we've had a 50% drawdown in May and this recent $10,000 sell-off in an hour, hodlers are generally pretty unfazed. We're still seeing this growing trend of long-term holder supply. It's very, very straight, right? We're just seeing this continuous increase in long-term holder supply. It's showing that conviction remains. They're not spending. We saw this in our dormancy and our revived supply metrics. So it is showing that conviction to hold remains. Now, the last thing I want to touch on is our liquid and illiquid supply, which I'm actually going to boot up the full-scale chart just to really explore this in full detail. So what we have here is our total coin supply, the 18.8 million BTC. And what we've broken it up using statistical techniques into is illiquid, meaning coins that are very unlikely to be spent. They're coins that look like on-chain, they're in cold storage, they haven't moved in a long time. We consider them unlikely to come back into circulation. So that's what we call illiquid in the blue. And then we've got our liquid and our highly liquid. So highly liquid are those that are in exchanges, they can be bought and sold with a single click. Liquid are coins that are kind of in between the two. They're great, and there's a curve that grades between the illiquid and highly liquid. So perhaps a coin's been withdrawn from an exchange. That means it's less liquid than if it was just to buy and sell with a single click, but it's got to go through a time period where it almost proves that it's going to be less likely to be spent. So we have this grading between illiquid, liquid, and highly liquid. What we're going to focus on here is really the liquid and the highly liquid supply. So what we're seeing here is really there's kind of three trends in play. For almost all of Bitcoin's life, and remember when Bitcoin was very young, the probability of it succeeding was much, much lower. People are speculating on whether it's going to survive, whether it won't. We're seeing more coins being mined. It's the great inflation, the overall supply schedule. It's issuing more coins from miners, so on and so forth. So we see this gradual increase in liquid, highly liquid coins. We see more trading activity, more coins flowing into exchanges, until we get into the end of the bear market in 2018. Now, this is when the market starts to really evolve. Derivatives start to come into the space, institutional players and hedge funds start thinking about it. It's kind of proven that Bitcoin hasn't died yet, and we're seeing this maturation of the market. And note how this strong long-term uptrend of early history starts to plateau, and we see this slowdown. Fewer coins are becoming liquid. More and more coins are going into an illiquid state. There's more hodlers, there's more people who believe in the asset, there's more accumulators. And then March 2020 happens. And suddenly Bitcoin bursts onto the world stage. We see institutions, we see very, very large asset managers start to talk about it in a more positive light. We see more positive media coverage, and we see this downtrend, this complete reversal of what was previously a very, very strong and structural uptrend. More coins that are liquid start to slow. March 2020 happens, and we get the reversal of this trend. Now, there was an inflow of coins, so people who accumulated and bought their coins at some point, many of those sold, and we note that from our previous newsletters, a lot of those sellers were actually up in this top zone. They're essentially top buyers. They panic sold. They spent their coins during the capitulation. We saw an influx of coins into exchanges. That obviously depressed the price, but then the market started to absorb them. And note that we've actually started to return, even though it's very early in this trend, we've started to return back to a downtrend. Now, the other side of this equation is mapping our illiquid coins, which has been also increasing throughout all of history. So it shows how much coin supply, some of them are liquid, some of them are illiquid. But note how we've continued this increase, and the gradient, the slope of this actually increases after March 2020. You can see that it's kind of plateaued through most of the 2018, 2019 bear, starts to trend higher in 2019. But after March 2020, it really starts to rise at great pace. A bit of a downtrend as those illiquid coins came back into circulation, and now we've resumed that uptrend. So the way to really interpret this chart is we're seeing more coins moving from a liquid state, freely circulating, easy to buy and sell, into an illiquid state. It's showing that demand to accumulate, the demand to HODL, is continuing to grow with time. So it's really demonstrating that from March 2020, Bitcoin really had a bit of a trend change. The investor sentiment and the psychology and just the overall appreciation of the asset essentially changed at that point in time. And incredibly, we can actually see this in the on-chain data. So we can really understand what's going on with the investor profile. What we're seeing is that we're still getting accumulation even during these very, very volatile periods. We see a 50% plus sell-off in May. We saw a $10,000 sell-off this week. And yet HODLers still seem to be fairly unshaken, which is quite remarkable. And we can see this in the on-chain data, both in the supply dynamics and in lifespan. So thanks as always for tuning in. Really appreciate you you're coming in to view these videos. Make sure to give us a like, a review, and a subscribe, and share on your various social channels. And I definitely look forward to seeing you in the next one. Cheers.